Mr. Gireesh Pradhan, Chairperson and Chief Executive at CERC himself joins us on the phone line from Delhi. Mr. Pradhan, really appreciate you taking the time out and speaking with us. Just a few clarifications. Firstly, you've kept the ROE unchanged, but you have tightened norms to get incentives. What was the rationale behind that?
Let me just inform you about the basic, philosophy has been that we've tried to have regulatory certainty in this sector, and that's the reason that you will see that the ROE has been untouched. And it has to be. You see, any regulatory regulation would have to be a fine balance that needs to be maintained. And this is what our draft, we feel, has projected.
But right. Mr. Pradhan, you've tried to plug the tax arbitrage window which companies like NTPC enjoy. Why is that?
Well, the point is that that was an additional burden that we felt was being imposed. So we've kept it at the the effective rate, which is what the NTPC or any other utility would be actually paying in terms of tax. So that was an area which we felt should be rationalized. All the other, we are giving the entire recovery of entire costs. We've also factored in inflation for the O&M, and we've tried to be very reasonable on this.
Mr. Pradhan, just a brief while ago we had the chairman of NTPC on the show, and he made an interesting observation. He said, look, these are just draft guidelines, this is not the final law, and the final law is going to be much more diluted because the industry is not likely to support this kind of a draft.
Well, I'm not privy to what the chairman and managing director of NTPC had to say, but the fact is that it is a draft, and we do go through a process in the regulatory framework where we do take a public hearing on this and also invite comments on this. So as far as that statement is concerned, yes, it's a draft. That's true, because we would, according to the regulatory process and procedure, we would definitely take this up for reactions and suggestions and comments.
Mr. Pradhan, since this is just a draft, when will the final norms come in?
The final, you see, the old regulations go on till the 31st of March 2014. So well before that, we need to finalize the regulations.
But when you say well before that, would it be before the calendar year close, that is 2013, or will we have to wait till Jan or Feb?
Sorry, no. It would be around Feb, I think, that we'd be able to, Jan and Feb, that we'd be able to, come out with the final version, so that it's in place for 1st of April 2014.
Mr. Pradhan, so if the largest player, which is NTPC, is not very happy with the draft proposal, which means the industry feedback is negative. So if the industry feedback is negative, can I safely assume that the final law will be diluted?
No, I mean, that's a lot of assumptions there. First of all, let me be very frank about this. These are very detailed draft regulations, which all parties need to really study in much greater detail, and then come out with their view. Right now, it has just been, I think, the reactions have been just off the top of the table. So, I think a little more study needs to be done on all sides, and the entire, rationale needs to be seen.
So just to clear the essence, power stocks yesterday cracked after your draft recommendations. Are you indicating that market reaction yesterday was very harsh, since this is not the final law, no one should panic?
No. You see, first of all, there's no explanation to how the market will react or what the market reacts to. So I'm not getting into that. All I'm saying is that these are the draft regulations which are very detailed. It's a very large, voluminous kind of a document which needs to be studied in much greater detail with a little more time. So that's the basic idea that I was trying to...
I have a simple follow-up question, Mr. Pradhan. The Indian power sector currently is not a very attractive sector for investors to invest in. If the new formula is implemented, there would be a significant fall on return on equity. Do you think now future investments will be less unviable? If the return on equity, return on capital goes down, nobody will like to invest more.
The return on equity has not been changed. The old regime continues.
Okay.
The return on equity is not changed. But that certainty is there in these draft regulations. There is some tightening of the operational norms, which I think is very necessary because ultimately the aim is to bring about more efficiency. So that I think is not really something which I would accept.
Mr. Pradhan, but the entire analyst fraternity is wondering that at a time when investment in the sector in any case is dwindling, why would you come up with such a move or even guidelines which will make the ROE fall and limit the capex, hit the profitability, etc.?
No, you see, there is no question of the ROE falling. We've kept that regime. We have also, given certain benefits in terms of keeping the water charges separate and allowing that. The operational efficiency norms have been sought to be tightened a bit, which is as it should be to make the whole sector more efficient. So personally, I don't really feel that the draft regulations indicate some sort of a massive skeleton on the utility.
Final question, Mr. Pradhan. There is some confusion on the PF and the PLF issue. At a time when coal availability is the issue, how are we planning to address the confusion between PF and PLF?
Well, what basically the rationale in the PAF and PLF was that the incentive part of it should be based on the actual generation. And just declaring plant availability and getting the incentive, we felt should be rationalized.
Mr. Pradhan, really appreciate your time, and I'm so glad that you could join us, and thank you for that clarification.